Good morning, everybody. My name is Rob Hay, and I'm the Head of Distribution and Investor Relations at Collins Street Asset Management. Many thanks for taking the opportunity to join us today for an exciting webinar on a new special situation opportunity that our investment team have identified. Joining me to present today is our Managing Director, Co-founder and Portfolio Manager, Michael Goldberg, and also our Co-founder and Chief Investment Officer, Vasilios Piperoglou. As with all presentations, these do run the risk of being a mile wide and an inch deep, and we do want to ensure that it is relevant to you and that we're able to assist with your due diligence. So if there are any questions that you'd like to raise as we go through, please use them in the toolbar on the right-hand side of your screen, or alternatively, do feel free to reach out to us directly after today's webinar. We'd be happy to assist with any questions you might have and to provide greater insight into the investment philosophy, research process, and thematic that we've identified. I'd like to highlight our disclaimer on this page here, and particularly note that the fund that we're intending to launch, the Special Situations Fund number 2, will be issued under an information memorandum and available to those investors qualifying as wholesale and sophisticated only. Naturally, it's important to read a copy of that information memorandum in full, and if you are unsure about whether or not an investment to buy any particular fund is suitable to you, please seek appropriate external advice. Where we do talk about performance figures today, please note that past performance is not indicative of what might happen in the future and are for illustrative purposes only. For those of you who are familiar with Collins Street Asset Management, you'll appreciate that as a firm, we're very focused on what our fundamental purpose is. And at Collins Street Asset Management, it is simply to make a difference, to help people who have accumulated wealth, family wealth, and built wealth over careers and through business, to make a difference in ways that are meaningful to them, either by preparing a legacy as a way to help family, community, children, and so forth, or to help them live their best life, however that may look. In doing this, we seek to firstly preserve wealth. And that's not to say that anything is guaranteed, but certainly that when we are looking at investments, we're having a very careful eye on capital preservation. And the way in which we seek to align our interests with our investors is testament to that. And alongside that, grow that wealth over the medium to long term. As deep value contrarian investors, naturally that sees us taking the road less traveled, being comfortable, feeling uncomfortable, and looking for opportunities in places that others perhaps aren't, or perhaps aren't willing to because of market sentiment, emotional reasons, or other factors. As I mentioned before, joining us on today's call are Michael Goldberg and Vasilios Piperoglou. Michael and Vas are our two primary investment team members and are supported by our chief strategist, Anton Lawrence, who also has a governance role within our business. As you'd expect, Michael, Vas, and Anton have all of the usual qualifications professional money managers would have. But one thing that does set them apart and makes them quite unique in the marketplace is that they have built, managed, and sold businesses outside of funds management, be it across hospitality, global publishing, and the like. And to that end, they have a very entrepreneurial, inquisitive, and hands-on approach to the way they think about investments and investment markets. They're equally very pragmatic, entrepreneurial, and inquisitive in the way in which they engage with boards of directors, the way in which they're prepared to approach other stakeholders across the industry as part of their fundamental bottom-up research, giving the scuttlebutt they do a very unique flavour and certainly a very contrarian one. Collins Street Asset Management as a business was launched in 2015 with our flagship Collins Street Value Fund having come to market in February 2016. Over that time, the business has grown to funds under management now of just shy of 400 million, with our flagship Collins Street Value Fund having achieved a net 14% per annum return since that time. Important to note is the Collins Street Value Fund, and I can appreciate that's not the focus of today's presentation, but it is important to bear in mind that the deep value, unconstrained, and high conviction investment mandate within that fund has allowed us to do research into some very niche areas of the market. and as and when those opportunities have arisen that we've been able to execute upon within the Collins Street Value Fund. Quite often our research has seen us look at international competitors, international peers. It's also seen us look at private opportunities, customers, suppliers, competitors, and those sorts of organisations which are part of a listed company's broader ecosystem. And so to that end, from the Collins Street Value Fund, we've had 3 other funds launch. We've had our Special Situation Fund number 1, which is a niche opportunity that was investing in offshore oil and gas sectors, listed on international stock exchanges, predominantly in the US, but also in Europe as well. That fund, launched in 2021, has achieved a return of 70% per annum, 70% net on a standalone basis since its inception. We've also launched a convertible notes fund, again drawing on that same research within the value fund. And that fund, with very much an income focus to it, has achieved its objective over the last 2 quarters. And a private equity opportunity, which we completed late last year, is still in its early stages, but certainly some exciting opportunities being pursued there as well. Of course, past performance, as we say on this slide, is not a reliable indicator of future performance. We simply call this out to give a sense of how the organisation has developed and the journey that Michael and Vas, as the co-founders of the business, have taken throughout that time. And so that brings us to our current opportunity. As many of you would be familiar, the Collins Street Value Fund has an allocation of about 15% at the moment to ASX listed gold stocks, either through direct equity or convertible notes. And this is a thematic which is naturally a high conviction one of the team, and one which we're very excited about as we come through into 2023. I'd like to now hand over to Managing Director Michael Goldberg to share his thinking into the investment thesis and the window of opportunity that exists for this high conviction view. Michael, over to you.
Thanks, Rob. That was a really good introduction. Look, I think there are probably many factors that can see gold prices go higher, but the one that we've been most focused on recently, and the one that really drove our decision to launch the fund, is around inflation. What we think we're seeing at the moment is really a structural, not a transient, or the structural impact of actions taken long ago, and perhaps cultural shifts that have happened more recently but are likely to be sustained, which we think will continue to impact prices and probably do so for quite some time. So you'll note on the slide we've got a couple of dot points here. Energy, I mean, I think we've all probably felt it, both at the petrol pump and also in the energy prices at home. We tend to think that it's not just a one-off, matter of the war in Europe or some temporary issue that's driven this. Our view is that this has been driven by essentially a decade of underinvestment in the energy space. For some people who have been following us for quite some time, they'll probably know that our first special situation fund was actually launched off the back of this thematic. As Rob pointed out, that's done quite well. But, essentially, we've seen a decade of underinvestment, during which time we've seen supply drop off considerably, while at the same time we've seen demand continue to increase. And I think probably some of that can be chalked up to the transition from, I suppose, traditional energy sources to what we hope the new world look like, with renewable energy taking over. But I think the process of making that transition has certainly taken longer than I think a lot of parties would have expected. I think it's more complicated than expected. And I don't think that there's an obvious solution in the short term, certainly as it relates to energy, that's likely to see prices in that space going down. And that, of course, flows through to every other aspect of the economy. I think manufacturing as well, it's more a story of onshoring to my mind. I think for a generation, or maybe as many as 3 or 4, to be honest, first world countries, advanced countries have been importing deflation from developing countries. And that's worked really well. What we've seen more recently, as we see prices increase in China and some of the other more popular places where we've been importing from, companies, corporations, and countries have started to try and find alternative cheap labor. Now, that will work in the short term to continue to continue to import deflation, but it becomes more and more difficult as time goes by. And I think on top of that, what we're seeing more recently, probably off the back of COVID-19, is that a lot of nations are discovering the importance of being in control of your own manufacturing, especially as it relates to core inputs. I think we discovered it's a pretty bad bet to rely on the mercy of your trade partners in a pinch. And so what we've started to see is, culturally speaking, a lot of countries have looked to bring back onshore a lot of the manufacturing that might have traditionally been done, or certainly the last couple of generations, been done overseas. I think as well, as it relates to agriculture or food inflation, I think it's certainly something that most people I speak to feel in their day-to-day lives. My in-laws are based in Detroit, and my father-in-law sent me a funny meme with someone trading in chicken eggs as if it were an illicit drug, given what the prices have done over there recently. So, I think between the onshoring process, I think between the increased cost of energy and also the tightness of the labour market, again, I think that's likely to persist for quite some time as well. Now, of course, we've got the central banks out there who are doing their best to try and put a lid on the inflation genie, as it's being called. And I think they're doing their best, but I suppose when your only tool is a hammer, I suppose every problem looks like a nail. And I think what we're seeing now, locally and internationally, is the consequence of the reserve banks and the Feds doing all they can do, which is essentially increase interest rates. We're certainly seeing it in Europe with Credit Suisse and UBS. We're certainly seeing the implications of rapidly rising interest rates in the US banking system. I'm not sure that the crisis that we thought it might be is what it's going to play out to be. But certainly, markets can only digest so much or so many interest rate rises in a certain period of time. Eventually, they suffer indigestion, and I think that's what we're seeing in the media and overseas at the moment. So I think our initial thoughts around why we would want to invest in a basket of gold stocks specifically, and potentially launch this new fund, was specifically related to that inflection point at which we note that central banks would have a continued interest to increase rates to try and cap inflation, but at the same time the market can't handle those rate rises. We certainly didn't expect it to happen so suddenly and all at once, but I think what we're seeing now is probably going to be reflected in central banks either slowing or potentially even ceasing those interest rate rises, even as inflation is at 6-7%. I think that central banks are probably going to have to get comfortable with, I suppose, a new normal, at least for the foreseeable future, of interest rates being outside of that 2 to 3% band that they are trying to achieve. So, we call that sort of situation, I suppose, negative real rates. I suppose, as it relates to investing in bonds or in bank accounts, if your money is earning a yield less than the increased inflation, you're essentially going backwards. So I suppose as it relates to opportunity costs, that probably speaks to that. If you're storing your wealth, like I said, in banks or in government bonds, likelihood is that your real value, or the spending value of that capital you put away, is going backwards on a day-to-day basis. And so what you tend to find in the broader markets, and there's no guarantees, it doesn't happen perfectly every time, but what you tend to find is that alternatives to cash, gold being one of the key ones, tends to do really well when you're experiencing negative real interest rates. Rob, did you want to flick over to the next page?
Can I just touch on a point on that previous page? I mean, I think the point to elaborate on is it's multifaceted. There are multiple independent reasons to why we believe gold makes sense in the current environment. And I won't go into every point that I agree with what Michael discussed, but it is multifaceted, it is independent, and historically, inflation, it's not that you only need inflation and then gold does well. It's what Michael said. If real rates are negative, that historically is kind of the inflection point of gold, and we think we have it right now. I guess the large caps have started to move, and that's fact. Doesn't mean they can't fall.
Well, gold prices as well have moved.
Correct, and so we think we are at the inflection point.
Yeah. I mean, some other drivers I think we're going to cover on the next slide are things like demand. In terms of recent demand, it's been interesting to see that demand for jewelry, consumer demand for jewelry, has been pretty strong over the journey. It represents about 50% of all global demand for gold, which was actually surprising when I first read that. I was unaware that rings and bracelets and necklaces represented such a large part of gold sales on an annual basis. Investment as well over the last couple of years has been pretty stable at around about 20% of total gold consumption or gold purchases. What we've seen more recently, which I think is especially interesting, is a significant increase in reserve banks across the world buying into gold. I think it represents about 25% of gold consumption goes to reserve banks at the moment, or central banks at the moment. Now, no doubt, some of that buying is probably a hedge against currency movements, and obviously a lot of banks internationally trade in different currencies, and perhaps if they're concerned about movements or some volatility in particular underlying currencies, they might look to invest in some alternative that's a little bit more stable, gold being one of those options. But I imagine that a non-insignificant amount has also been due to a loss of faith, I think, in the US dollar as a reserve currency. That's not to say that the US dollar is about to lose its reserve currency status. I don't think that's the case. But I do think that they've done themselves no favors in recent history with significant quantitative easing and a tremendous amount of spending and printing.
And weaponizing.
And weaponizing as well, which brings me to the next point perfectly, actually. It's also become apparent that there are certain types of countries that are less inclined to store their money in US dollars. The reasons behind that might be multifaceted, but I would call out from a geopolitical perspective, it's been very interesting to watch the implications of the sanctions on Russia. In the first instance, the thinking was, I think, by the broader world, was that sanctions were going to cripple the ruble and see the economy in tatters. The almost opposite has happened. In fact, the ruble has strengthened over the journey. We've started to see trade being done in currencies other than the US dollar between Russia and China specifically. And I imagine we'll probably see a little bit of that going on over the medium to long term.
I think with that point, I think their intention, we could argue whether it was correct or not, but the intention and the outcome were two different things.
For sure.
And the outcome is, unfortunately, a lot of nations, whether we like it or not, have lost faith in keeping a lot of their assets in US dollars.
Well, if you're a nation that has concern that the US might not like you as much as you like them, then there's a risk to holding US dollars. Again, I don't think we're saying that the US dollar is likely to lose its reserve status. I think that's unlikely. But I think it is fair to say that it's looking probably as shaky as it has for quite some time.
It's losing its market share. It's still number one. It'll probably still be number one in 20 years, but as a percentage of global trade, it's losing its market share.
Yeah, I think that's reasonable. Yeah. I think we can also add that, and this is an interesting point, that as developing nations move to a level of prosperity, what we tend to see is an increased demand in luxury items like gold and like jewelry. I think a great illustration of that is if you look at China and India, which are two nations that have done spectacularly well over the last few decades. They actually represent about 50% of consumer consumption in gold, or about 25% of total consumption of gold. So that we thought was quite an interesting point on the demand side. Obviously, demand will drive prices. The reasons for the demand can vary, but it's very interesting to see that there are, again, multi-facets, reasons why demand continues to be strong.
I think it's a fact. I can't remember the precise year, but the central bank buying in 2022 was the highest since the late 60s.
Yeah.
And that's a fact.
Yeah. And I mean, as the slide says here as well, it's about 15% up from the year before. And from what I've been able to see from more recent stats, it looks like that increase or strong demand from central banks has been maintained and continued. So, I mean, I think, in the short term, there are lots of tailwinds for the gold sector. I think there are many, and I think they're substantial. And I think at the moment, it seems that a lot of them are blowing in the same direction at the same time. Vath, did you want to elaborate on anything that we've covered, or perhaps on the next slide?
Nothing on this slide.
Okay, so Rob, next slide, please.
So I guess if we want to talk about the opportunity, I mean, at the end of the day, we're all here to make as much money on a risk-adjusted basis as possible, and trying to be as conservative as possible according to, I guess, the underlying investment or the opportunity. We think the window of opportunity is now. Now, when I mean now, is it 1 day, 1 week, 1 month? We're not sure, but we feel it's in the short term. and I'll elaborate more. So, you know, a lot of the stuff we've mentioned, whilst it might come across as our opinion, it's not. It's, you know, we're trying to mention some facts here. You know, the central bank buying is fact. Inflation that is here is a fact. Real negative rates is a fact. And I guess the first point is not a fact yet, but we feel it may be around the corner. So we feel that because of the rapid increase in interest rates over such a short period, the negative consequences to that is obviously clear, and it's become apparent over the last couple of weeks, the unintended consequences. We always felt, even before this week, and why we were bullish gold for probably the last 6 to 12 months, having been a decent size of the Collins Street Value Fund's portfolio, we always felt that at some stage rates will have to stop or pause or not rise as much as the market anticipates. And the reason for that is because there's so much debt out there, whether it's you know, whether it's government debt, whether it's private debt, whether it's corporate debt, it doesn't matter which way you cut it. There is too much debt out there, and we always felt that, you know, rates would never, in our opinion, for a medium to long term, you know, go to double digits. So we think again, it doesn't matter. It doesn't mean it can't, but this is just what our opinion. We think it won't. And I guess what will be interesting will be to see what the RBA does and what the Fed does at the next meeting. Now, you know, they could still increase once more, but we feel the language will kind of hint towards either, you know, they're either near the peak or they will pause and wait to see what happens. Yeah. We feel that should that eventuate, that should be extremely bullish for gold. And I guess when it comes to the equity space in specific commodities or specific thematics, the reality is you do get most of your alpha from the small to mid caps. Yeah. Now, you know, we would love to just buy the big, you know, the big new crests of this world and feel like we've done our job. But the reality is when you buy the mega caps on a specific thematic that is about to inflect, you usually don't get that extra alpha. So,
but you also don't get value. You're buying stocks that are fully priced.
Correct. And there's a plethora of reasons to why, which I think we can elaborate on the next few slides. But we think the window opportunity is quite narrow. We think it is now, and hence why we're really excited to launch this new fund.
Okay, thanks, Michael and Vas. Now, of course, if we have this thematic that's in place, the question is, how do we practically go about capitalizing on this opportunity? And so the mandate that this new special situation fund will be operating under will be very similar to a lot of the other funds that you'd be well versed in from Collins Street Asset Management. Our investment philosophy remains 100% the same. Deep value investment ideas, unconstrained in where we find value, and certainly high conviction. And to that end, we'd envision this fund at inception holding a portfolio of 10 to 20 domestic and globally listed holdings. Now, these will typically, as Vas mentioned, be in the small to mid cap space, bearing in mind that small to mid cap, and I'm sure Vas will elaborate on this further throughout the webinar, small to mid cap does mean different things in the context of different exchanges. Vas will also be giving some high-level insight into some potential holdings into the fund later on throughout this webinar. As you'd appreciate, we can't share exact names of holdings at this stage because we're yet to get set in our position, but certainly we would expect ongoing reporting to be very similar to our first special situations fund in the oil and gas offshore servicing sector. The fund will be driven by the gold thematic. However, there may be exposure broadly to some precious metals, silver and the like along the way as well. But gold is certainly the dominant theme within the portfolio. It will be long only. There'll be no gearing at the fund level, no derivatives used, and we will have the potential for convertible notes. Although again, very much the expectation should be that this is an equities fund. The investment term we would see being about 3 years. Now, it's always difficult to say with precision when a niche, high conviction special situation like this might come to fruition. It could be earlier, it could be a little bit later, it's hard to say, but 3 years is certainly the intention. And we are mindful of investor timeframes when issuing products such as these. And so if the fund is such that it would go beyond certain periods, then redemption windows would be made available. The fund will be absolute return focused. It is not one where there should be an expectation of income, but looking at the highest overall return that we're able to generate throughout the life of the fund. Now, there are lots of different ways of gaining gold exposure, and certainly we have received some questions through the toolbar around which stage of production, exploration, and so forth we might invest in, whether we look at quasi-equity, seed equity, and so forth. I'll leave that to Vas to cover off in his section more acutely, but what I would say is that there are a plethora of ways of gaining exposure to gold, be it through physical bullion, which would require storage, insurance costs, and the like. Noting that, of course, and again, this is something which will come up in a few moments, the price of gold and the price of gold mining companies don't necessarily move in lockstep. So something that's very important to think of when you're looking to capitalize on this thematic. Derivatives are certainly an option, but can be complicated and can introduce their own form of leverage in different ways and complexity. So tends to be something we steer away from. There are a range of exchange traded funds that are out there with different mandates and different opportunity sets to them. Certainly direct stocks, which is something long only deep value stocks being our specialty within Collins Street Asset Management. And certainly there are a range of debt instruments, either listed or bespokely negotiated, which are possible as well. As you can appreciate, our preference is certainly in the direct stocks and occasionally in the debt instrument space. But whenever we're looking at an investment idea, and we say this here on this slide and I can't emphasize it enough, simplicity and asymmetry lie at the heart of everything we do. We don't want to have multiple catalysts or multiple contingencies or dependencies for an idea to re-rate and appreciate in the marketplace. And certainly, by having a very high bar set for any addition to the portfolio and preserving capital and focusing on acquisition price very acutely, we can look for those ideas which have the best asymmetric risk return profile, essentially trying to call the toss of a coin after it's already landed. And on that footing, I'll pass over back again to Vas to talk about the thematic for gold and how he's going to go about picking the stocks for this particular portfolio and how it will look. Vas, back over to you.
Thanks, Rob. So I guess, you know, any one chart or any one fact or any one point in isolation doesn't mean much. So I guess it's all of them combined paint a picture. In saying that, I do think this picture is quite interesting and it gets us very excited for the main reason that this is not, in our opinion, just a thematic. It is not just, you know, Vas and Michael are bullish on gold, so gold stock should go up. It's a little bit more than that. And this thematic is a value thematic as well. I mean, our opinion is even if gold doesn't rise much further than it is, you know, the stocks could still have some significant upside. And this chart says it all. And why do I say that? Is because in commodity space, it is much about supply as it is about demand. And as you can see on this chart, the global gold production, which is really the supply of gold, in the last 3 cycles, every time that the gold price production started to fall, you had a significant increase in the gold price. Now, you know, I'm not here to tell you that, you know, it's going to repeat what it did in the late 60s, in the 70s, and gold's going to go up at 1,580%. I'm not saying that's going to happen, but what I am saying is you know, the direction with the supply and the demand. So clearly, as you can see in the most recent time frame, so I think it's around 2017, 2018, that's when gold production started to decline. And then you can say, well, why did it start to decline? Well, the same reason to why, I guess, the energy sector supply started to decline. The gold companies, whether they're large, whether they're mid, whether they're small, there's been a reduction in the amount of new exploration. And there are a plethora of reasons to why that's happened, but I guess all we need to know that it has happened and it is happening. And I think this chart, it just goes to show that it's not just about the thematic on the upside. It's also, you need to look at the supply side, and it seems like supply of gold production is falling. So if you move to the next slide, again, this is a lovely chart that, one chart in isolation is not the full story, but it's another example of just adding to what our view is of this thematic. So you can clearly see, I mean, it's not even close. You can clearly see the gold price versus, I think it's the Philadelphia Gold and Silver Index per share. So I think it is a revenue per share, so it's not earnings. But again, if you assume resource stocks on a specific commodity tend to follow the underlying commodity, then there should normally be a positive correlation. But there is a huge disconnect, okay? And normally when this happens, something needs to move. So if you look at this chart, it's either the stocks have to go up a lot or gold price is about to collapse. So obviously we've made our opinion on what we think gold's going to do. So clearly this is a great chart to show that there seems to be some significant value and disconnect,
catch up,
and hopefully catch up with respect to the share prices and the underlying commodity. So again, we're sorry that we're just talking very high level. We would love to run you through the specifics of the companies that are already on our hit list. Obviously, everyone would understand that if we did that, then we wouldn't have a fund. So unfortunately, we do have to keep it at a relatively high level. But in saying that, we do like to keep things very simple. You don't need to overcomplicate things. In no particular order, we look for proven management with track records. And you say, well, what does that matter if it's a good resource? It does matter, because it reduces the risk on the investment. There is enough potential investments out there with good projects, whether it's pre-production or production. There is enough good quality listed gold companies out there that have proven management, that have done it before, that you can look into. And so that's kind of one of the first things we always look for. Second thing, again, it's kind of obvious and it's common sense, but we look for management that have significant amount of skin in the game. And I don't mean $100,000 worth of shares. We're usually talking about millions of dollars of shares, or a significant portion of the register. That is critical to us. I mean, even if we had a proven management, but management did not have skin in the game, it probably wouldn't make our list.
It would certainly raise a flag. Why are they not backing their own business?
Correct. Jurisdiction is very important. I guess it's quite obvious for mining projects are inherently, obviously, there's lots of regulatory hurdles to go through. Rehabilitation is obviously a big part of any mining project. And so, again, you don't need to look for the risky jurisdictions to make a good return. In fact, you could argue the upside on good quality gold stocks with proven management and potentially significant amount of skin in the game. The upside on whether a project is in a questionable jurisdiction or a good jurisdiction is probably the same. So if it's the same upside, but the downside significantly reduced, then we try to stick to the tier 1 jurisdictions. Another important point, and again, this is obvious to us, it may not be obvious to others. especially if a company is pre-production, we try to make sure that they've already had that cleaning of the decks with respect to a capital raising. We are generally, and again, there's always exceptions, but generally speaking, we are looking for companies that have already raised a significant amount of cash. And it's important to us because, like all small to mid-cap mining companies, it's about the least amount of dilution as possible until they get to the inflection point in production. So if a company has already raised cash and is sitting on a strong cash balance, and we feel that gold's about to inflect, it is better to hone in on the companies that have already raised money, done the hard work. Proven gold in the ground, that was just there to kind of inform the listeners that we're not interested in stories that may have gold. We want proven gold, usually through a good JORC, and we're not looking to invest in moose pastures. It's the gold has to be, it's proven, it's there. It's not a hunch. It's not a the neighbor has gold, so we have gold. It's kind of an obvious point. And then the last point is asymmetry with stock prices. So you can have all other points ticked, but if on the back of the envelope you do a kind of an intrinsic valuation on the underlying company, whether that's from a PE ratio or whether that's a DCF of a prospective mine, or whether that's kind of a rough valuation of ounces in the ground, we need asymmetry. And we're looking to hopefully buy stocks near or at their lows, and hopefully we can take advantage of the upside.
I mean, really, that speaks to your previous point on this is a value play as much as a thematic play. We're looking for those companies that are cheap based on current situations, not relying on blue skies and hopes and dreams. Correct.
So if you turn to the next slide, Rob, or the next slide. So again, I apologize, we're only going to be able to talk very high level, but the next two slides, and Rob can just toggle through the both, A and B, both of them tell the same story. They're obviously companies that, well, one of them's an Australian company, one of them's an international company. Both of them, they've got proven management. Management have large skin in the game, very, very good jurisdictions. It is, I mean, this just, again, I don't exactly remember what the gold price was in 2020, but I believe that was the most recent previous high, which was around $2,000 US an ounce, which we are at, or at close to currently. So effectively, from the peak to where we are currently, the gold price has not really changed much. It's the same. Yet, the stocks that we're looking at are 56% and 72% off. And I believe both stocks haven't had much dilution. So there is clearly something wrong. And we hope that it's as we said, a bit of asymmetry here. And these are the situations that we love to delve deeper into.
I mean, it's even stranger for the company that has Australian assets, given that gold in Australian dollar is, I think, as high as it's ever been, about 3,000 Aussie dollars. So it seems strange that you'd be languishing at a level that suggests we're 3-4 years ago.
And what we're seeing is it's not like these small to mid caps are cheap and no one wants them. It's I should have put a slide of the large caps. The large caps, the larger cap stocks are moving, right? They are nowhere near their 5-year lows. They've moved a lot. It hasn't trickled down yet to the mid to small caps. And so to us, that's not a matter of if, we think it's a when. Assuming gold price doesn't collapse, we think it's a when. And that's why we're really excited.
I think, Rob, back to you.
Yes, thanks, Michael. Thanks, Vas. So certainly we have the deep value investment thematic, investment opportunity supported by a thematic with a strong tailwind to it. The important thing, of course, is to look at the way in which, as a fund manager, we continue to align our interests with those of our investors. The important thing to recognise is that we do have zero fixed ongoing management fees. There's no 1% per annum or whatever the number might be, simply for turning up. Now, granted, for this fund, we do have a one-off establishment fee, which is deducted out of the value of the investment upfront. And that's because investments such as this do have unique costs for their establishment and so forth. That being said, at maturity, the fund will be charging performance fees based on a unit price of $1 per unit. So if you're investing at $1 on day one and it was 98 cents after the fee, the performance fees would only apply after that dollar. So effectively rebating that 2 cents back at term. We also have an alignment of interests in the way that we will be investing alongside our clients as well. Michael and Vas will be investing at least $1 million into this fund on the same footing as our investors, and other staff members within Collins Street Asset Management will also be participating in this opportunity. So again, very much performance driven on absolute real returns for our investors, not simply one where we collect fee revenue on an ongoing basis throughout term. As the saying goes, the opportunity of a lifetime must be seized within the lifetime of the opportunity. And as Vas highlighted, the window of opportunity for gold is certainly a narrow one, and one which we see being quite explosive once it does turn around and take off. And so for those of you who are looking to join us on this journey and participate in the fund, it is important to note that it is available exclusively to those qualifying as sophisticated and wholesale investors. The minimum investment amount under the information memorandum is set at $250,000. However, we do recognise that clients will have relationships with us across multiple funds, or maybe wishing to build a relationship with us over time. And so if you do wish to participate in this investment opportunity, but have some queries or questions around minimum investment amounts based on your circumstances, please reach out to us. We'd welcome the opportunity to have a conversation and work through what options would be available. The information memorandum, which is the important governing document for the fund and one which should be read and accessed in full before signing up for anything, we expect to be available early next week along with the application forms. And I'd certainly be happy to share a copy of the IM and forms with anyone who would like to. And certainly as a business, we're able to assist with the pre-population of paperwork and support through the process as well. Now, there will be a 3-month opening period for the Special Situations Fund. It is possible there could be future opportunities to participate, but I would suggest that the primary opportunity will be over the next 3 months. And we'll be striking unit prices in April, May and June of this year at the end of the month in order to allow people to participate at different points if they want to, and also arrange their affairs so they can join us in this opportunity. So if this is something that you would like to learn more about, either have a one-on-one conversation, video conference, or receive a copy of the application form and information memorandum, please feel free to reach out to me directly. I'd be more than happy to assist with any questions that you have and to support you through the process should you wish to join us with this opportunity. I'd like to thank everybody for their time today. We have had some questions come through, which I'd like to, Vas and Michael, if you'd like to bring your camera back on, some questions which I'd like to raise with Michael and Vas that have come from our members. So firstly, Vas, Michael, have you been in gold before in the Collins Street Value Fund at any point? And if so, how did you go?
Sorry, what was the question?
Have we been invested in gold before, and how did we do?
Yes, well, we currently are invested in gold, and
I think 2019 also we had a significant holding.
that is true. That is true.
And we did quite well.
We did quite well in 2019, I believe. But again, the most recent investment via the Collins Street Value Fund, and I believe it's approximately 14 or 15% of our NAV is in gold. I mean, we think it's just started.
Yeah, it's very early days for our current investment. Yeah.
Very early days, unrealized. I couldn't even tell you net are we up or are we down, but it's relatively new.
Yeah, but to Vas's point, we invested in gold in I think 2019, just on some concerns for a bit of the crazy we were seeing in the world. Gold tends to act as a good hedge or get good insurance against uncertainty. Now we didn't pick COVID-19, but having bought a basket of gold right on the precipice of a market crash, with the world freaking out about what the world would look like in the next few years, did turn out to be quite a fortunate investment.
Yeah, I think we roughly doubled our money. Obviously, there was no inflation then, and gold moved pretty quickly, and we didn't think there was an inflation thematic, and I vaguely remember I think we doubled our money, or close to.
That's about right.
But that was a smaller portion of the fund there. This is a significantly larger portion of the current Collins Street Value Fund.
Yeah,
and there will be, clearly for the ASX listed stocks, we've done a lot of the research already, and I'm pretty sure there's going to be an overlap of some of the ASX listed companies currently in Collins Street Value Fund and in this new Special Situations Fund number 2.
Yeah.
Okay, so in the Special Situation Fund number 1, there was part of the investment thematic anyway, it was around increased corporate activity, particularly on the M&A front. If the gold price does take off, do you see there being an uptick in M&A in the small to mid-cap gold space?
Yes, and that is because of one of the charts that we put up previously, because of the drop in supply of gold production, which is really a drop in supply, because a lot of the majors aren't investing as much as they used to in exploration. A lot of the exploration kind of has been left to the smaller guys, and
get gold up,
and the smaller guys don't move as quick on exploration budgets as the big boys. But if they're left to do it, then yes, I do think there's going to be a lot of M&A. Clearly, we saw a bid for Newcrest. That was a large M&A, and I think that's still in the wings. But yeah,
we also own a company that's merging at the moment, don't we?
Oh, that's right. We had a convertible note in a company that just got taken over. So we've already had M&A within Collins Street Value Fund.
It's actually quite surprising when you get to know the gold regions and you discover how many small players there are out there. It's actually quite astounding. So we're starting to see movement in the large and mid-cap space, as Vas pointed out, and I imagine we'll probably see the same, or we'll see bigger players taking over smaller players as the thematic continues to play out. Again, there's no guarantees in this world, but that's our sense of how we expect or how we imagine things will play out.
Yeah, okay. Now, we talk about Tier 1 jurisdiction in the slides, and you say that, Vas, with reference to mine locations and so forth. What jurisdictions will the companies be listed in? Naturally, some will be Australian shares, but there is a global element to this too. How far afield are you prepared to go?
That's a good question, and we never want to be hamstrung, but on a very high level, we normally speak to, only look to invest in jurisdictions that we trust, jurisdictions that have a strong rule of law. So, the ones that obviously are, likely to be homes to some of our investments is obviously Australia, America, Canada, certain parts of Europe, and that's probably going to be the majority.
Yeah, I think Vas made the point earlier. When these small and mid-cap stocks start to move, we anticipate that they'll move quite fast and quite strongly, and there's not a lot of value in taking additional risk, given that we expect to see some very solid returns from the companies we already invested in.
Yeah, I mean, I wish when we invested in the uranium thematic for Collins Street Value Fund, which we did very well in, that was slightly different because there literally was not choice. There was only half a dozen listed companies, and we had no choice. So one of our largest investments was Paladin, and yes, Paladin made mines in Africa, Namibia, but that mine was already built. That country actually has a pretty good track record in uranium. mining. So it's not like we would never invest in nations that might smell like they're not tier one, but what we're saying is the majority should be tier one. But we want to have some flexibility as well.
Okay, and so in terms of market cap, then, what are the general parameters around the size of the companies you would look to invest in, and what does this mean for the size of the fund? Is this a fund which can take as much money as investors choose to participate, or is it constrained in some way?
Good question. I mean, I don't think we're going to raise $1 billion. I would love to. So if
could
we
you allocate $1 billion?
I'm sure we could try, but I don't think that's going to happen. So if we think about where we think we're going to raise the capital, I dare say, again, we tried to work backwards. It's so long as the criteria of the companies, the underlying fundamentals of the companies, they tick the boxes, then it's a practicality question, right? What's the daily liquidity? If we want $1 million on a specific stock, but the only way is to push it up 30%, well, we're going to pass that opportunity. And on the flip side, we're not really interested in funding companies, because one of the caveats is we already want them to have cash, right? So we're not looking for companies to come to us as the white knight for their capital raising.
Not bailing people out.
That's not the intention of this fund. So if I had to best guess the smallest market cap we might look to invest in, it'd probably have to be 50 to 100 million. We're looking at 10, 20 million market caps.
Not looking for seed capital opportunities or anything in that space. Very much. Yep. No. Okay.
I mean, again, I think in the IM it outlines that we're looking to take between 10 or 12 and up to 20 positions, which means depending on how much we raise, there needs to be capacity within those stocks for us to get a 5% position.
Correct. I mean, let's assume, and I'm not saying this is ironclad, but let's assume we raise 100 million and we want 20 stocks.
5 million per stock.
That's a decent amount. That's 5 million a stock, and on a 50 million market cap, that's 10%. Like that
doesn't work.
That's a lot. So I think it will be around 50 to 100 should be the smallest.
Yep. Okay. Fair enough. And so this will very much be a standalone fund. It would be fair to say, not one seeded by other funds within Kasan.
No, standalone fund. The same as the special situations #1 fund. It's almost identical to the way it's set up. It's slightly different, I guess, on the fee structure, but everything else is pretty much the same. Michael and I putting in our own money on the same footing. I think our own units will charge our own fees as well. Don't know if that's the most tax efficient thing, but yeah, that's what we'll do. So yeah, it will be standalone.
Okay. Now let me just have a look here. So how broad is the mandate, Vats? Will this fund only invest in, say, those explorers and producers? And as you say, we're not looking to buy moose paddocks or anything like that. Very much late stage explorers, early stage producers. But does the mandate allow you to go into, say, servicing companies or companies that have a peripheral role in the sector?
Yeah, look, I think the answer is no. We're not interested in gold services or anything auxiliary related, but there is a caveat that I know we're talking about gold, but it's it is there's 1 or 2 targets we're doing DD on that's silver related. Silver is the form of gold. It's usually they usually follow each other. So yeah, between gold and silver, so explorers and producers, that's probably as far as we would take it.
The short answer is they're not looking to invest in service companies.
No.
Okay, fair enough. Now we have had a question come through that they note, Vas and Michael, that you are very busy people, and certainly since the launch of the Collins Street Value Fund, a number of other funds have been brought to market, and no matter how efficient we are, we only have the same number of hours in a day. the question was around how does this impact workload and so forth. And the way that I had a chat with someone about this yesterday, the way that I've described this is that as this is a fund which invests in Australian equities as well as international equities, and the Collins Street Value Fund already has a meaningful allocation here, a reasonable amount of the work has already been done. And certainly when we are looking at stocks, as we have as with all of our opportunities, really, in much the same way as the oil and gas fund was born out of MMA offshore, or GPI was born out of RPM and National Tyre and Wheel. We do look at other competitors, be they domestic or abroad. And so the research underpinning the thematic has been done. A lot of the companies have been looked at. And it's also important to note, and this is not to create expectations of any particular outcome or timing, but do note that our offshore oil and gas fund is about a little bit over halfway through its life, and that over time, some of those positions will be falling off the research register as well as they are eventually had those positions unwound. So there is dare I say it, a recycling of time which will occur from one thematic across into the other as we go through. Now we have.
Sorry? I think it was good. I mean, were you looking for us to add to it? Because I'm not sure that we can. That was pretty well.
No, we'll save time for the next question here. What about Bitcoin rallying on the back of the Credit Suisse saga? Is this a counterweight to gold's bullishness?
We will not speculate about speculative Bitcoin.
Look, Bitcoin is not something we've been comfortable with from the beginning. We wish people were investing at the best of luck. We just don't know how to value it.
I mean, the only thing I can think of is the general investor type that is attracted to Bitcoin is kind of anti-government, anti-banks, and because banks have been falling over, that there's a euphoria moment that they think they're right. That's the only thing I can think of. But based on fundamentals, unfortunately, I've got no comment.
No, fair enough. And the final question we have, I'll field this one, is why other investors haven't participated in this opportunity or haven't launched a fund in the same way that we do. And I think that there's a few moving parts to it. And the starting point is that Collins Street Asset Management is a business built by investors for investors. I think there's a natural degree of entrepreneurship that goes on. And alongside that, there's also a very strong desire to not follow the institutional imperative. We're not trying to manage billions upon billions of dollars such that the only opportunities we can participate in are your Newcrests or your a lot more efficiently priced stocks at the larger end of the market. Because we do seek to align our interests through performance-only remuneration structures, we do take a tight view on capacity, and we do want to preserve the ability to access opportunities in the small to mid-cap part of the market, where other investors might love to go there, or certainly in the institutional space, but the amount of funds under management they look after preclude them from certain opportunities where we can be a lot more flexible, nimble, and bring that deep value, unconstrained approach in a more nuanced and certainly more niche way for our clients. Now, we have used the hour that we have allocated for today, and I'm very mindful and respectful of everybody's time, and thank you all for attending. We do have a quick poll which I would like to ask your thoughts on, which is quite simply, how you feel about today's webinar. Certainly, we're always in the market for good ideas and how we can improve and get better, and we do value your feedback. A copy of today's presentation, the recording and the slides is available. And again, if you would like to receive a copy of that, please send me an email. I'd be more than happy to share it with you and answer any other questions. Thank you all for your time today. We'll leave this webinar open for another minute or so, and then we'll finish up. But thank you and have a great day.